I'm Julian Leuthold with Get Global. I'm the founder and CEO, and I'm being joined today by two very experienced uh, deal makers and folks in the M&A and private capital raising space. Um, we have Benjamin Bidlack, who is a longtime executive, having served through Southeast Asia and North America, focusing a lot on brands and the marketing and outward facing side of companies in major parts of his career. I'll let him explain a little bit more about that. And we also have, and he's joining us with NMS Consulting, which is a super interesting firm that's, well, we'll get more into that later, but it assists clients in sorting out a lot of the issues that they have before they go to raise capital, but it's also strategy and other items that we can get into a little bit later with Ben's feedback. We also have James Robinson, who is from Herbert Smith Freehills. It's a global law firm with special strengths in Europe, Asia, and the Middle East, and parts of Africa. He has spoken at Get Global before, and he has been a partner of ours. He's a really interesting guy, and we're going to get into so many interesting things with both of these speakers, including M&A, raising capital, and a few details on some topics that I don't think get enough notice or discussion. One of which is CFIUS, which I think a lot of folks in the United States, depending on their industry, get scared about. So, Ben, say hi.
Hello, everyone. Welcome. Thanks for joining us. As Julian mentioned, my career started in management consulting. Well, first a stint with Wells Fargo back in the 80s, 8 years with Wells Fargo in different roles in marketing. And then I made the shift to management consulting, working for Booz Allen, first in Singapore, and then Accenture in the US, and then moved into independent management consulting with a number of former McKinsey and BCG partners. And then the last third of my career has been in brand strategy consulting. So how do we translate business strategy, i.e. what's our value proposition, sort of in black and white, into a brand that really connects with not just our customers and our staff, but prospects and the market at large. And where that comes to play in our discussion today is when there's some kind of financial event, an M&A, a purchase, an acquisition, a raising of capital, a going public, any of these large, a merger, a roll-up, getting into the private equity kind of realm, how does a brand and in a larger sense, how do intangible assets affect the value of that company? As we'll talk about, there's the traditional EBITDA performance measures and valuation methods, and those are important, and those can be done in parallel in addition to the intangibles calculations, which are a relatively new area, but as we'll see today, it's also the preponderance of value in the S&P and in all public companies throughout the world. So pleased to be here. Thanks for inviting me, and I'll pass it over to James.
James, hi.
Thanks, Ben. Hi. So quick intro to myself. I'm a lawyer based in New York, but as you'll be able to tell from my accent, I'm not originally from New York. I'm from the old York in England. I've been with my firm now for about 20 years, based in London, as well as out in Asia for 13 years, based now here in the US, supporting our US clients as they get global. So a very appropriate forum in terms of working with Julian. My personal practice is on transactional work, so that's supporting US companies as they enter into joint ventures or acquisitions or raise capital from foreign investors in particular. So there's always tends to be a cross-border element to the work that I do. And obviously in terms of today's topic, very relevant in that the market has changed quite dramatically in a very short period of time. So in terms of describing what the new normal is like, we'll try and cover a little bit of that, but it is still evolving. But there are certain themes from past experience and seeing how current deals are being treated and current capital raisings are being treated that we can hopefully, between Ben and I, share with you.
Excellent. So what I want to do is tee up the conversation a little bit. And you'll have to excuse me, we track our Slack channel as the whole conversation goes on. We do this for seeing comments that roll in and for gauging interest on particular topics. So if you're following along on Slack, let us know what you're interested in, what you'd like us to follow up on, and any questions that come up along the way. Here at the Get Global Broadcast News Network, we listen to our feedback live. So since coronavirus set in and we had all the concomitant issues come up around that, folks are needing capital, they're looking at their strategic landscape and their industries shifting, and it's an opportunity for some to buy or edge out in front, and then there's an opportunity for others to potentially sell and escape what could be a long winter for them. So a lot of the folks in this chat have brands that have intangible assets. They have a strength in their industry that they may not know how to evaluate, properly. Maybe they've never been through an M&A deal before. Maybe they've never raised capital from a domestic or a foreign investor. So we're going to get a little bit into that. And so, Ben, please do tell us, how should people be thinking about intangible assets and how that weighs into an investor's thinking in the current landscape?
It's a great tee up. I think that the idea of intangibles, as I mentioned, is still or has been in the past misunderstood, and because it's misunderstood, we've all migrated to and fallen back on traditional EBITDA methods of valuing our companies. If we're thinking of selling our own company or building up our company to sell in some kind of exit, or if we want to merge with another, or even if we're considering buying a smaller firm or another firm, we fall onto the fundamentals, which are still important. Let me make sure I stress that. The cash flow, the assets of the company, the tangible assets, and the performance on a revenue and a cost basis are still important. They don't go away. But this larger, more and more, so I'll reference this Ocean Tomo study a fair amount, and we can get that to our listeners. Perhaps after the call, we can forward the link and the study itself. It shows that from 1970, I think it was the mid-70s, 76, through to 2015, the proportion of tangible versus intangible assets in the S&P 500, for example, went from tangible at 24% or so, and intangible at 24%, and tangible much higher at 76, all the way, and flipped. Now it's intangibles are 76 to 82% of the value of almost all U.S. companies. And the preponderance of an intangible of all that value. Think of Google, think of even Apple, the Apple brand, just the brand. Now, not its copyrights, not its property, not its formulas, not its tangible assets. Just the brand is 200, and I think the latest in Interbrand was $232 billion. So if you're going to buy Apple, you have to tack that on to the price. And the idea, one quote, I was speaking with a top PE firm last week, and one of the general managers said, EBITDA measures of valuation still matter, but intangibles represent multiples. So whatever the value of the company is, if you have a valuable set of brands, copyrights, IP, but particularly brand, that can mean a 3x, 4x value for your company. And even Warren Buffett has talked about that he can make much more money managing the intangibles of companies than the tangibles. When we think of sort of M&A, and we'll talk about how COVID is applying to this, but when we talk about M&A, most people think of finding synergies, reducing cost, and finding new revenues for the new entity. And those are all in parallel, those are all important at work streams to follow. But the intangible, if you're talking about 80% of the value of a company, someone needs to be measuring, and you can't manage it without measuring it and understanding it, measuring and optimizing that into now 80% of the value of companies now, including smaller companies, a small agency, a small manufacturer, a small services company. So it scales with the size of a company.
So everything flew out the window 3 weeks ago, 4 weeks ago, right? So how is the current landscape adapting to this, both the EBITDA method and more inflected intangible asset style of thinking about valuation?
Yeah, the COVID crisis serves to shine a harsh light and reveal both the strengths and weaknesses of all companies. And in particular, a strength that I think a lot of companies are finding or finding it challenging to find is there a flexibility, because it has not only changed and closed in some cases, completely closed down operations for some companies, but it's also forced companies to pivot, to change either their fundamental or maybe add a new business or add a functionality to their business, delivery of restaurants, for example, or moving online if you're a fitness company, as a couple of examples. Or one more example is a company I'm working with now is a healthcare company. And almost all healthcare companies you can see now have pivoted to telederm or telehealth, or what's called virtual visits with practitioners and clinicians. So the COVID crisis has accelerated or shined a light on areas of a company that they may have delved in a bit before, or ways to operate from everyone working at home, or in some other way, it's forced them to change how they operate. And what that means for companies is that the fundamentals are still the same. They haven't really changed starting day one. They didn't change day one. Now, of course, 2 or 3 months in, many companies will be facing many challenges, and cash flow probably the top one. But on day one, it's much more about how flexible can you be. And that translates into people in the company. Are they able to change jobs and take on more work that they didn't do before? Or is everybody locked into just their role? So on a company level, are you flexible, and can you ride this storm out? And at a personal, individual employee or executive level, can you take on new jobs, learn new areas of functionality and capability inside your company while you're trying to keep the lights on and stand up another business? I'll just finish with one other example. This healthcare company, in a matter of 5 days, they were able to stand up to become operational in their telehealth practice, which had been languishing, I would say, because not out of inattention, but because they didn't need to stand it up. All of a sudden, the COVID crisis hit, or some other crisis could have hit, and they all almost dropped everything they were doing. Everyone took on jobs that they weren't their usual area and learned. And they had to figure out everything from legal, and we'll have James comment on this, I think, further. They had to figure out the legal ramifications of operating, of treating patients via telephone or video. They had to figure out the insurance policy and regulatory sides, all within, and they did it within 5 days. And the doctors weren't used to doing that. They had to figure out their own personal technology setup. And it was 5 or 6 days they had their first appointment. And now it is a viable, in fact, extremely valuable, probably the most important source of revenue during this crisis. But that was because they saw that they had to close their centers. You know, their business was built on in-person treatments. They had to close their centers and stand up an entirely, what is essentially a entirely new business from scratch. And I think a lot of the listeners on the call have similar business or are being forced to rethink and take on more to just to survive. And so that's just one example. James, I'm
Big time,
I'm
folks. Ingenuity is an intangible asset. And it matters, right? I mean, a lot of folks are going to be judged by how they handled this moment, and the people who reacted quickly and got their act together are going to be rewarded, I think. It took us about 5 days to launch the COVID Response Network, by the way. James, interesting stuff going on with you. I mean, you and I have talked about this a few times, and it seems like there are some interesting new behaviors going on in the M&A space, particularly around the law and how folks are abiding by it or choosing to be a little bit flexible with what's in the contract and so on and so forth. I mean, obviously people are abiding by laws and things, but how they how they interact with their counterparts in another time might be different than how they're doing it now. What's your perception on that?
I think that's right. I mean, like everybody, we're all having to be a little more agile in how we do our regular jobs in the new circumstances and new environments. And M&A is no different from that. I mean, I think what I've experienced and what the markets have experienced is there's clearly been a drop-off in M&A, a marked drop-off, something like 50% decline in M&A value just in the last 2 weeks alone. 33% decline in rough terms in terms of number of transactions that would ordinarily be expected to occur. So there's been a drop-off in M&A and people are adjusting in terms of how they're getting deals done. I think the two biggest issues, and they touch upon some of the points that Ben has made, the two biggest issues that are affecting it is one is valuation. The historic kind of valuation models are kind of thrown out the window as everyone tries to work out what the values of companies are, both in terms of wanting to invest in them, whether it's minority investments or full-on acquisitions. So the difficulty of valuation and trying to go back to what is the fundamental value of the business, and that's where the intangibles comes in, and Ben stressed that point. And I think that is where investors, both private equity and strategic investors, are trying to look to when they're trying to do valuations. And then the second thing is obviously in terms of process, there's fewer auctions happening at the moment. It's difficult to run auctions. Everyone thinks you can do it all online. And in theory you can, and in practice we all do. There's online data rooms all the time to affect auctions. But the physical face-to-face meetings is very useful at building rapport, building confidence when you're doing a transaction. So whether that's in an auction process or an exclusive investment from one party to another, the ability to adapt on that and have conference calls and Zoom calls all the time to try and get deals along, that is the new reality, and deals are being done now by Zoom, including the distractions of having kids and dogs and all sorts of interruptions during the middle of a call is becoming the new normal. People are becoming way more tolerant from that perspective. So the process is changing slightly, but the bottom line, I think, really goes back to valuation. That's the key hurdle in terms of M&A deals.
Anybody making deals over virtual happy hours? Let's hope we can one day get to that. I'm slow to that.
You're working with. I've had deals into Asia where it's morning coffee versus happy hours here in the US.
So in terms of like the strategic landscape for a lot of industries, I mean, when you look at packaged foods, they're obviously having a heyday. In some cases, they're having challenges in supply chain and things like that. But folks are stocking up. We know a few companies that are just struggling just to keep things on the shelves, and they've got people working in their facilities round the clock. Others not so lucky. On an industry basis, what would folks, not necessarily calling out specific industries, but on, you know, folks looking around in their own business industry, what would be the signals that people can use to understand their own strengths, their own vulnerabilities, and start to develop a sense of how they fit into the current landscape? And by this, I mean, you know, there's some folks on here who are not the biggest in their industry, uh, but they don't have overhead the same way that the big companies do. They have a stronger brand. They have a special niche. There are a variety of factors that make them actually pretty interesting as either investment targets or acquisition targets, or you know, uh, pivot cases. So, what are your feelings on this, Ben? How should companies be thinking about themselves?
It's a great question because it's thrown, as James mentioned, all boats and will sort of rise or fall with the general atmosphere of M&A, let's say. But within that tide, within that rise and fall, you can still stand up and get some advantage from a brand standpoint vis-a-vis your competitors or your peers. It doesn't have to be a direct competitor. It could be, all healthcare companies, and even healthcare and wellness, for example, a gym. So what companies I think should take the time to do, and it doesn't have to be, you can do it in one day if you focus on it, is almost what we do at NMS or many other firms, including McKinsey. You do a mini study of in this case, it would be a brand study, which includes three main areas of research. You need to understand your own company strengths, some of which are latent because they've been brought to the surface by, let's say, the COVID pandemic. But you still have a core strength, a core purpose, a core set of capabilities and advantages that you've gone to market with up till now. So you'd want to get a catalog of how that's been expanded or changed based on COVID. Right, and when I say get a sense of that, I mean articulate that, write that down. It all sounds, and I know most companies, I think, have a false sense of shared purpose, we all think our brand is the same thing. We all think we stand for the same thing. The truth is, it's not always the case. So you have 15 versions of what our company is. But this is a good time to circle the wagons and get it written down on one slide or in 2 pages, what we stand for, especially what our core capabilities are in the face of this pandemic and how that may change. So that's 1. 2 is, what are our competitors and peers saying and doing? And what can we assess are their strengths and weaknesses from a brand standpoint and maybe operations? For example, the healthcare company I'm working with now looked right quickly at all the payers, the insurers, but also their competitors, their other offices and offerings, and could see the messages they were putting out, could see the businesses they were trying to stand up, could see the brand positions they were all taking. That should help you tune your message and your next steps. It doesn't define you. We don't let the competition define us. That comes in step 1. Who are we? But the step 2 is, how should we, knowing that our competitors are putting these messages out into the world of our shared prospects, people who are not our customers yet. How can we first clarify our position, perhaps a new expanded position, and deposition them, you might say, elbow them out in the process in one fell swoop. So that's the area of 2, is the competitive landscape and understanding what are these messages the last few weeks. And then the third area is, in this case, it's customers or prospects. So in the healthcare area, those include providers and clinicians, but also patients, and also non-patients who may not realize they could benefit from a treatment or a service. And so you need to get close with what are people worried about? Yes, everyone has an overall raised anxiety level with the COVID crisis. And that will continue to ride along, even as we start to open in phases or in certain areas of the world or country. That will still be an underlying anxiety. But they still are buying things, as you mentioned, Julian. There are companies that are doing extremely well. Delivery companies, Amazon, paper product companies, firearms companies, companies that happen to benefit from selective hoarding, but also other companies that are more out of the limelight that are benefiting in this just by luck. In a sense, I don't mean to characterize that they're lucky only. They're strategic as well, but some industries are getting a lift because of they happen to provide something that's really valuable or available or easy to serve. So those three areas. So for example, we're going to be talking with 100 different patients and prospects. Individual interviews. You can call them up. You can send them a quick survey on using SurveyMonkey or another quick, easy service, and you all of a sudden you will start to see what are their top concerns and how do those line up with what you say about yourself, and tuned by, modulated by the various competing messages that are out there. And you've basically done a little mini brand study. You've done a little mini rebranding. I'm not saying change your entire reason for being, but this may have pitched you into a new adventure for your company, and perhaps a new advantage that you have found a flexibility and a capability that is a rebirth. It's a 2.0, a 3.0 from where you were before, that is actually now extremely valuable. I know I've worked with another, a gym chain, the largest gym chain in the US, who has now found an area of treasure, you could say, in their own operatings online that they didn't even know they had, that now has turned out to be a really strong advantage that is not easily copied, and they're taking advantage of it. So it's a chance to, you can do it in 2 days, and if you're a larger company, you should be able to do it in a week. That you can say, let's research these three areas. What does that now say to us? How should we then do a mini brand? I'm not saying you have to change your logo or change. You may want to refresh your logo, but how does it change your what I would call your brand strategy, your messages for the world? And that will help you lift just that much more above your peers and competitors once we see the end of or the phased end of this crisis.
James, what do you think about that, and especially also like the strategic landscape that folks are thinking through from your vantage point, particularly in the cross-border space?
Well, I mean, there's lots of good points there, but to pick up on a few, the kind of overarching one is just the agility aspect of a lot of the Get Global community. The fact that they're able to move quicker. I mean, usually in a crisis like this, in a financial downturn like this, it's the larger companies that are seen to have the bigger balance sheets and able to ride out the storm, where actually it's more the SMEs who are able to adapt their business, to look at new opportunities, to reposition themselves. It doesn't have to be a complete rebranding or remixing of the company, but that their ability, as Ben says, to do that. And it doesn't have to be a huge exercise. Often if they're in the right zone anyway, and especially because of the size, it's relatively easier to do that repositioning. I mean, I think from the landscape, from a legal perspective, the first series of questions all the lawyers are having were the kind of firefighting questions. What are the immediate things I need to do to preserve, just to stabilize the business? And the kind of three biggest issues there, and I mention this in terms of an M&A context, because this will come up in any diligence exercise you're going to do for an investor or on a transaction. The three biggest firefighting issues is the supply chain, your workforce, and your material contracts. And the issues there are exactly what you'd expect in terms of securing the supply chain. What happens if there is delay in the supply chain? How does that affect your business? What are the legal rights under the documents? Force majeure clauses, delay clauses. Workforce, clearly lots of issues there in terms of preserving the people and the value in those assets. Tied into that, how do you take advantage of WARN Act and equivalent provisions around the world to the extent you've already got an international footprint? And in an M&A context, the immediate firefighting instinct is take the cash, take the loans, take whatever support you can get. But it's important to note, and I know you're thinking of doing a separate session on some of these workforce issues, But a lot of these loans, a lot of these support mechanisms require certain certifications about how you're going to run your business over the next year. So if you're contemplating doing transactions, doing partnerships, joint ventures, selling, closing, expanding, you are then going to be bound by some of these requirements of taking federal funds. So firefighting is what it is, but you need to look beyond once that fire's put out as to how that is going to impact your business. And then the third aspect was the material contracts and termination rights in terms of your customers as well as your suppliers. So similar to the supply and distribution chain risks in analyzing your business. So the first set of issues are those firefighting issues, but those are still key. The second is then, as Ben says, to look at what the opportunities are. And here again, agility is going to be key. You know, there will be situations where you think we can reposition our business slightly. The question is, do you have the skills or the assets to do that? And even if you don't, who are the partners that you could work with? This is a situation now where, to the extent that financing is a little trickier than it used to be, other companies will be happy to do partnerships with you, to do joint ventures with you. And those are a lot easier kind of transactions to get done in this environment, because when it comes to the valuations, both of you are in the same boat. You're both going to struggle to justify what your valuations are. So share for share deals or new joint ventures or partnerships where you don't have to rely upon existing valuations, but you're creating a new venture to take advantage of these new opportunities. I think you'll see a lot more of those kind of transactions. And I'm involved in a few of those at the moment, which started pre-COVID, but haven't been impacted at all by COVID. The transactions are motoring along. The biggest issue is the Zoom call rather than the actual fundamentals of a new joint venture that they're looking to set up outside of the US.
Yeah, so you mentioned what was going on, transactions that we were in the middle of as the virus hit. What is the global situation with force majeure and issues like that? Is a virus an act of God? Can we thank that guy who ate the bat, or curse him, depending on where you land on that issue?
I was going to say, it depends whether you're an atheist or not on that one. The reality is, for those transactions that have already signed, for those that are in progress in terms of negotiations, there is a pause on a lot of them. Joint ventures aside, where I've seen those move along quite rapidly, there is a pause. Everyone's trying to understand exactly how it's going to impact deals. And the main impact for ongoing deals that have not yet signed is valuation. What's the business now going to look like? Which means, in principle, for getting those deals to signing, it's going to be more diligence. There's going to be more focus on diligence. People will take their time to understand the business, understand all of those points I was saying are firefighting points. What are your supply chain risks? What are your employee issues? Right down to financing. Is your financing secure in the longer term? Any triggers under your debt, immediate debt financing? So the diligence is going to be way important for those deals that are in progress. There is stuff you can do in terms of the documentation. And I think this is probably what you're alluding to for those signed deals, which is often you have what are called material adverse event clauses or triggers, which allow you to avoid closing if there's been a material adverse change in circumstance. So everyone agrees the deal, they sign it. Usually there's a few closing conditions in terms of regulatory approvals, financing, antitrust. If you have a financing condition, you may be okay. You can get out of a deal if financing is more difficult. But the one that everyone is talking about, a material adverse event or material adverse change clauses, MAC clauses. And that's what you've probably seen in the news in terms of Bed Bath & Beyond have tried to, they've commenced legal litigation in the courts of Delaware, similar in terms of SoftBank and WeWorks. Lots of allegations there being thrown around. And that's where the fun and games and strategy starts in terms of, can you really rely upon those kind of clauses? Because they're tough.
That was exactly where I was going with that. So WeWork and SoftBank. Ben, what's your take on that deal? Do they have?
Well,
yeah,
it's a legal Wild West I'm speaking out of my area,
Oh, I'll
but
get back to James. I just wanted to get your quick take too.
I would say it's illegal. What I would say from the brand, from the internal standpoint, and I'd love to hear what James adds to this, is that this is a chance to fortify and pandemic-proof yourselves, and or you can almost say recession-proof as best you can yourself. So this is a chance to highlight and build and fix and prepare for the next force majeure, for the next whether it's a pandemic again or a second wave of COVID or some other set of circumstances that will equally highlight all the usual luxuries. We don't think of them as luxuries, but the luxuries of financing, the luxuries of nice inflated valuations, the luxuries of a stock market that keeps growing perpetually, or seemingly perpetually. I know we all love that in one dimension, but it's also or just even a financial crash of some kind or correction that it's not caused by any particular thing. The companies that I know have, and I'll just mention one other item, the companies that I know have all of a sudden, they're caught a bit naked, showing that they're quite tied to, and they're only living month to month, or they're living quarter to quarter, or as soon as a pandemic happens again or another wave, they're going to have an equal crisis again. And they have stopped and made a priority to rebuild and go down to the basement, clean up your basement, be ready for this kind of thing again. Some industries are naturally more recession-proof, makeup, cosmetics, food, but some are also more vulnerable. So take a hard look at that from a brand and show potential acquirers and or merge partners or joint venture partners that you are more prepared certainly than your peers, even though you're in an industry that has some risk attached to it, but that you're building new areas of revenue, new businesses, and new fortifications that make you much more attractive as a acquisition partner. And I'll just add one more point.
Very valuable for these
Companies
folks
that
on the
I
call.
know, for example, the force majeure and the legal issues are kind of a wild west. There are precedents, but there's a lot of gray area and concern. There's also a similar area of concern, of gray area, around getting these loans from the government, from the U.S. government, or any other loans that might be either from Europe or other loans that may become available, funding that may become available. Well, how do we apply for it? The banks we called don't do it yet. And it's a big mess. And the banks don't even know. Well, I say again, this healthcare company we're working with stopped everything, and they waded through. It's messy, it's not clean, it's not known, but they got their application together, and then the bank came back with many more hoops for them to jump through. They jumped through those as best they could. Everyone else in the industry just kind of put their hands back, almost like a raccoon or a possum, and just they sort of were paralyzed in the face of uncertainty. And two companies I can think of, the gym chain as well, just took action and said, yes, it's messy, but let's get this application. So they've put the application in. If they get that application, smooth sailing, blue skies, unicorns, and rainbows forever. But and they can't control it to a certain point, but they could control their application and making it a priority and staying up for 4 nights in a row and getting it done, and they did. And other companies sort of, well, we're not sure, so we'll just wait. And so I urge all the people listening and others to have less tolerance in yourself for just sort of being paralyzed, and just start. And if it's messy for you, it's messy for all of your peers, and you can come out in front, and they have a good chance of getting approved for this multi-million-dollar forgivable loan as any, and probably more so than any of their peers, and we'll put them in, but again, they're doing other things as well. So it's just another example of action. It's some strategic thought, but then a lot of action that's and it's just not normal. It's not comfortable, but it's standing them in great stead right now.
We're going to come back to online, offline, pivoting, reassessing in just a second, because we had a question from the Slack channel on that. But I wanted to tie up one thing real quick with James. James, tell me more about the SoftBank and WeWork deal. I don't know how many folks on the line are going to be affected by this, but I think it could be telling in case folks get into the middle of a deal through this issue and somebody starts talking about, you know, having to back out for some reason.
Yeah.
James, what do you think?
I mean, to tie it actually back to what Ben was just talking about, and I'm not still trying to process the possum in the headlight image there, but to tie it back to that, in terms of the commercial reality of moving quickly, you will see both in the kind of SoftBank or Bed Bath deal as you will do on smaller deals, which is sometimes you just need to move. You need to move quickly. And I know it's not very often you hear lawyers say that because they always like to slow things down and, you know, dot all the I's and cross all the T's and go through every process. But just as with applying for some of this funding under the WARN Act, just go ahead, get it done. It's important to move quickly to take advantage of some of those things. Similarly, on the SoftBank Bed Bath kind of deal, the reality there is, and it's interesting, there's always a list of conditions precedent to closing. So for your specific question on how does this affect the deal and what's really going on, the conditions precedent to closing are pretty standard. The material adverse change there is pretty standard. The reality from a legal perspective is the material adverse event or material adverse change are very, very difficult to rely upon. I think there's been only one case in the Court of Delaware, which is the kind of prime court for commercial and corporate disputes. There's only been one case where a material adverse event has been allowed, because the fundamental is that the drafting of it you have to show that it's affected you disproportionately, your target business disproportionately, compared to the rest of the market. So yes, it can cover, depending on how you draft it, acts of God. It can cover pandemics, and those that have drafted it to specifically use the word pandemic would be very happy with the World Health Organization, one of the few Americans that are, in terms of designating it as such, because then that falls straight within your MAC clause. But the reality is, if that's affected everybody in the market the same way, how do you show that you're disproportionately affected? And that's the key difficulty. And that applies not just under Delaware law, but also all of the laws of all of the states, New York, California included, and internationally. It's very difficult to rely upon the MAC clause. So why are the parties suing on this and relying on this? Often it's a strategic point to renegotiate the deal. And so you'll see some of these court actions are definitely, we just want to close this deal at this price, and that's what the guys legally agreed between them. So let's just get it done. And usually that's on the seller's side that they're happy to force that through. But in most situations, both parties will say, yes, no, things have changed. We may need to actually go back and relook at it. And interestingly, the Bed Bath example is very good in that it's the claimant there is Bed Bath have filed the case against 1-800-Flowers to close on the personalization.com acquisition. So that's about $250 million deal. In all of the correspondence that's been filed on that case, nowhere are 1-800-Flowers saying MAC. What they're saying is, look, things have just changed. It's virtually impossible to even assess whether the conditions have been satisfied. So we're just putting a pause on it. So they haven't actually themselves, the defense hasn't been filed yet, but they're not actually saying we're relying upon MAC to pull. They're just saying, look, things have just changed. And that's the commercial reality. You just have to react to what is there. So in terms of the audience, the Get Global audience, you can document your deals. You will be able to document transactions if you're in the middle of it. This is a point at which you can try and insist on a closing, but equally there will always be the commercial reality of discussing between the counterparties, listen, what's the best next step here? Yeah,
big time. And I think it's nice to hear, it's nice to hear this because, sometimes I think folks get tied up in contracts and what it says, and people sometimes forget that there's a realm for strategy and all of that, right? Like renegotiating, coming back and looking at certain things, making sure that everyone comes out, or at least yourself, as good as you can. Big question I know that's on the mind of a lot of folks here is who's got money? I know that China is sort of looking at this as an opportunity to make some investments. Probably some folks out in the Middle East as well. What would you guys say about all this? Who are you seeing being a little bit aggressive, um, perhaps seeing their moment, and how do the folks on this call go and find them?
James, let's start with the global, and then I'll give a limited view for what I've seen in the U.S.
Sure, sure. I mean, the two main areas are private equity. Got a lot of dry capital, so they're coming up with more interesting structures. You're seeing that a lot, and I'm sure Ben can pick up on that because a lot of his clients are in that sphere. The other aspect is, as you say, foreign money looking for investment opportunities, and in particular China, who are coming out of the COVID situation ahead, just timing wise, recovering quicker than the rest of the world. Plus the eternal advantage of having strong government funding, financing, support to go and make most of the opportunities that are out there. So in an uncertain time, we are seeing a lot more interest, and certainly my colleagues from my Beijing, Shanghai, and Hong Kong offices, they're the ones that are calling me most in the last couple of weeks with potential new transactions, looking at new opportunities here in the US. And that is not just in terms of acquisitions, but also minority investments. So that's why I'm seeing the money coming from. As you mentioned, Julian, the key issue with dealing with that is CFIUS. And for many of the Get Global community, often you hear about CFIUS in the multi-billion-dollar transactions, or you think about it in terms of defense transactions, aerospace, or major technology or telecoms companies. And the key thing for people just to be aware of and have on their radar is it applies across all different kinds of sectors, not just full acquisitions, can include minority investments. Even it used to be that there was an unwritten threshold of 10% and more would be covered by CFIUS. Now, expressly in the new legislation that came out in the last couple of years, it includes transactions below 10%. So if you're thinking of raising capital from or being acquired by a Chinese company, certainly being acquired, CFIUS will come into play. But even taking on additional financing at this point, if you're taking any minority stake and giving access rights or sharing technology, and again, cross-sector, this will apply. So you'll have seen transactions in the online dating apps, in healthcare, technology apps as well, where Chinese minority investments have been unwound by CFIUS.
And just to explain a little bit about CFIUS for those who are hearing about it for the first time, that's the Committee on Foreign Investment in the United States. It's run out of Treasury. It's an interagency committee that looks at deals where foreign investors are investing in the United States. Used to be primarily about strategic industries or defense, security related issues, but now it's including all kinds of stuff that's been widely broadened out over the last what was it, last year, May of last
Yeah,
no yeah
2018 regulations coming out.
2018.
Yeah.
And so that can include lasers. It can include anything that has personally identifiable information. It can also include real estate, anything within a certain amount of space from a particular site that the US government owns or that's deemed important in some way or another. So don't want to get too much into that. We'll probably have a separate call about it. There's a lot of folks worried about it, thinking about it. We actually know some folks at CFIUS, so we might be able to bring them onto the Zoom chat. But yeah, so that's a big deal, and Grindr found out the hard way, right? That was an interesting case where they clawed that one back. Hopefully they'll make it out of that one intact. I think they're going public, right?
Yeah. And the other thing to note with the current environment in COVID and how that's impacting CFIUS is across the world, there are equivalent regimes, foreign investment review regimes across the world. The Europeans have been very quick to say, in the current climate, companies may be willing to accept money quickly and desperately. please be aware we will still be enforcing the Foreign Investment Review, especially thinking of China and especially thinking of sensitive technology or data. So the impact on COVID is irrelevant, as it were, for CFIUS. There will still be issues in terms of accepting Chinese cash.
Yeah, and this is a trend that we covered with James at Get Global last year. We did a whole session on how this is a new phenomenon, getting much more serious around the world. So Ben, we did have a question around the online to offline transition, whether that's gyms, whether that's event companies, whether that's ticketing companies, anything that has traditionally relied on people actually going places and doing things, restaurants. What are some of the really creative ways that you're seeing folks navigate that space, and any advice on what you're seeing so far? Are you impressed so far?
Well, you can think about Zoom. Um, think about Zoom. A month before the virus, or before, let's say, it was widely understood, and all of a sudden, everyone's knocking on Zoom's door to say, oh, not just individuals, but companies all of a sudden need this capability much more quickly. So the companies that actually provide either, let's say, online healthcare. Now, I will say this healthcare company is one of the top providers in the country. They're using Zoom for some of their, so that they didn't try to build their video capability from scratch. There are times when it's better to just either partner or just become a customer of Zoom, a corporate customer, and get yourself online that way. And you can imagine all of the, and the doctors most of them only have one phone, for example, and maybe a desktop, but yet they also need to look at patient photos or video while they're treating. So how do you do that so they had to figure out, well, we need to give all of our clinicians a tablet. How do we do that? Or we need to do, I know there's email services out there, there are a number of them, where the company's usual bulk email, service or company isn't either equipped or isn't available during this kind of thing. They've had to go and let's just sign up MailChimp, and someone has to figure that out. And sometimes there's not a team to go figure that out. They have to don't think that you have to build it yourself. Someone's usually built some kind of either partial or full capability for you. You can just partner with them or become a customer with them. They need, that customer, those providers, let's say email, conferencing, online. In the case of the gym, there are a number of online workout video providers that, and it's not just a question of putting videos up. There are caching issues, there are volume issues, and all of a sudden there's going to be, there'll all of a sudden be 10-fold the number of people, 100-fold the number of people signing into your site. That could crash your site. So the companies that I've seen do that well is, don't build what you don't need to from scratch, especially it's not your business. Find people who do, partner with them, become a customer of theirs, and see what there may be. It's not quite bartering, but there's in some cases has been some tolerance for either, as James mentioned, share swapping, or you could say value swapping, where people, even in a PE firm, a couple of the PE firms have let's say they have 100 portfolio companies, and across the spectrum of industries and functions and services they provide. There was no reason why they couldn't keep it in the family, so to say, and reach out to all the customers from all of their portfolio companies and say, here's all of our companies, here's what they provide. You might not know them, but they're your sisters and brothers in a way, in that we're all related through our PE firm. What services can we offer you at a discount, or share value, or even share people and skills to help all of us through this? Now that's a case of private equity. For an individual firm, I know a number of them, and James, you probably have seen a lot of this come across your desk, is some of the typical rental agreements, landlords I've seen. Some of them are just, we have to walk away from our lease right? If we're going to pay for all our leases, we'll go under in 1 month. We'll be done. So, or we're going to selectively, and so you call your landlord ahead of time. You work with your equipment leasing companies. You work with your other bills and say, can we do 3 months? Can we do a 3-month quick agreement to we'll pay in full in August, or we'll do some kind of other financing to help us save our cash flow for the next 2 months, for example. And I have found through various clients that they've been able, that the people are, even landlords who are used to having rent every month, and they don't have a lot of leverage. They can't just say, well, you know, we're going to enforce this and be the big baddie at this time. There's a lot of sort of moral lift to help people, give people a little more leeway than usual. But even 3 months at a time, if it's a big service you're paying for, or a big landlord you have, or a big other bill you have, a lot of those debtors are being fairly forgiving and flexible. And that can help you get to where we either reopen or partially reopen for a lot of these companies that are based in-person businesses.
Yeah, I was speaking with an organization that we deal with fairly often, and they are a trade association. They represent an industry where there's a lot of in-person things going on all the time, and they've been noticing that a lot of their members are being way more permissive on the basis that you know, if they were sharks about their contracts, certainly they need the money, they need the sales, but if they were sharks on these contracts and the deals that were made just before the virus hit, you know, that's the last time that person's ever going to deal with them. And that word gets out. I think that in the back of everyone's head, they're all recording, you know, who treated me right, who did the right thing, who would I like to work with again. You know, there's a lot of new alliances being built out of this right now.
Who tried harder? Who
Yeah.
tried harder to do things that I know is hard? And I will say, on the healthcare and in the wellness areas and workouts, a lot of them have offered free things during the period, and they're going to take a loss. Or sometimes it's a thing you can offer, like their video libraries. That's free for them, essentially. And so they're saying, sorry, members, we can't have you. We're closing down. We're going to not charge you, and we're going to provide you with our free video libraries that we normally regularly charge $20 a month, $40 a month, $60 a month. And when we reopen, we'll consider offering you the chance to come in at a lower price than we normally would. But for now, to keep everyone moving, to keep everyone healthy, and I think the good ones tie into their deep purpose. Why are you in business aside from making money? Aside from paying everyone's salary, what is your purpose in the world? Do you say it's to help people? Okay. Whether
What
you're
are
in
you doing?
healthcare or you're a lawyer, or
Yeah.
whether you're a hosting company, you're helping in some way, let's say, and you've articulated that. Well, now's a good time to prove that. And it may not be super profitable, but it can be a brand touch point that could say in someone's mind, it's not going to change the fundamentals of the business. They're not going to pay you triple because you did this for your company. They're not going to pay extra billions of dollars, right? But I remember what Julian said. I thought what James said, and I know he didn't have to do that, and he helped me with that contract for free, and he said he'd bill me later in the fall. I know that Target, or pick a company, you know, a toy company, a gas company. You know, I really like that they're going to not charge me finance charges during this period. I saw Geico and a number of other insurers say we're going to lower people's auto insurance rates during this time because we know most people aren't driving as much, so there's not as much risk to us. But it also is a gesture. It's more than a gesture. It's a chance to say what you really is important for you, to state your values as a company. You're not making money from it most of the time, but it's a signal to investors, shareholders, with the market overall, what you stand for. And that can make a difference when you're looking, for example, we're going to buy this gym company or that gym company, or this hosting company or that hosting company. Well, that can be a tipping point. It's intangible, but important.
We're going over just a little bit, but I think that folks are getting a lot of value over this. So if you have any remaining questions, certainly if Ben, James, if you guys need to jump, let me know. But
I'm good.
James, you all right?
Good.
Okay. James, how do you follow up on that question, or that comment rather, about, doing the right thing versus doing the thing that you could do if you wanted to be a shark about things? And then we have another question coming up about, like, how do folks, like, especially in healthcare and things like that, find strategic partners in a hurry? But uh, over to you, James.
Okay. Remind me. First question was which?
uh,
The sharks.
yeah. How do
Even
you?
when you could. I mean,
And this is a soft question, right? Like, what are you seeing? Like, how are people behaving? What's the sort of mood out there?
I mean, as Ben says, the reality is people are being more flexible and being more forgiving. And that goes throughout. That's not just in terms of looking to your customers and trying to be more forgiving because that's the key to your business, but also throughout the supply chain. So going to your landlords, going to your suppliers and asking for forgiveness for easier terms of payment. And that's the easiest thing to do. And we've got clients that are a lot bigger, large multinationals who are financially perfectly fine. They can ride this storm, but even they are saying, we're being asked, so we're going to ask our suppliers as well. So that is the norm, is to go and ask for forgiveness. Now, that same client that I was speaking to said one of their suppliers tried to, in terms of get out of any payment obligation on the basis of force majeure, on the basis of the current climate. They're not so forgiving, but they're forgiving in terms of delaying. So deferring payments on your supply contracts is actually the new norm. And as Ben says, you will remember if that forgiveness is not there. There are alternative suppliers along every supply chain. So, people, that is the new reality, at least for the short term. And then the second question.
So we've got a healthcare company who is seeing their
Right.
moment. They're based overseas, but also, this is a good question because I think, we've got a couple of trade commissioners in here who are probably counseling companies about how to interact with the United States around what's probably a big opportunity right now. How do you find? I mean, any advice? And this, asking James first because he's on camera. But Ben, I'll ask you too. How do you find strategic partners in a hurry and not mess up, either with investment or getting into an agreement for distribution, things like that? It's straying just a little bit with that aspect of the question, but nonetheless, I think it's probably germane to what people are feeling right now.
Go ahead, James.
Yeah, I was going to say, to pull on one of Ben's points, look to your existing contacts, look to your existing relationships. So if you do have any private equity involvement already, or any existing investors who have their own network of companies, you will have a family there. There will be sisters and affiliates there. And that's the easiest in terms of getting done quickly. It's the easiest in terms of building relationships and confidence in terms of knowing your existing partners, existing investors, and therefore bringing that confidence level up. So even, and again, just to develop slightly one of the points that Ben made earlier, if you already do have an investor that has a suite of family companies that you can turn to, when we mentioned earlier of being agile and looking for new opportunities, and maybe we should be partnering or joint venturing, this is exactly why private equity does its investments the way it does. It builds a suite of companies and tries to leverage by pulling together the best from all of them. But equally, in a situation where you don't have a private equity investor, PE funds at the moment are looking for opportunities. So approaching PE and approaching financial advisors and consultants who can link you in with the right PE houses, they've already done their analysis on where the opportunities are. What's interesting for the PE funds now is they're having to think about, okay, there's new opportunities. Let's revisit where we thought the partnerings could be and what can we piece together. And it may be that business strategy number 5 in terms of priorities is now business strategy number 1, and we need to get a new member in the family who can service that. So there's always going to be opportunities that way. So I see PE as being central to moving this along pretty quickly.
What do you think, Ben?
Very well said, James. And I would add to that, there are some PE firms that are using this chance, particularly with COVID, to look for opportunities. opportunistically to say what may be available at a reduced price, I would caution that to say it may be a reduced price because they've been revealed to be less strong than they might otherwise look. But I will also say that in two of the clients I'm working with now have just literally cold called a huge company. They didn't have anyone. I mean, someone might work at a mid-level, and they might have had to say who should we call. But it literally the CEO to the CEO, or the CMO, or even a senior exec that doesn't have, not part of the C-suite, can make a call. People are open to, and you don't have to worry too much about it being so perfect as it was before. James mentioned it as well. People are more. I won't mention the name, but it's a household name in healthcare providing, and you wouldn't think that you could propose a partnership. And it was I would even say it was a proposed partnership that was all laid out and figured out ahead of time. It was actually, I would bet that there are synergies. I would bet that there are capabilities that complement each other, and we're reaching out. We'd love to have an intro conversation. It was that open and simple, and not just in that case, but in another case as well. And the company making the overture was not a household name, and so you didn't get all of that sort of reputational and credibility sweep with a reach like that. And it didn't have to be so formalized and heavily protocoled. So I think it's much more about person to person, or an actual earnest, genuine openness to talk. Not everyone will say yes to that. Not everyone you'll get a beautiful appointment, with a CEO the next day. But I think the rapport and protocol requirements have fallen away to some degree, even internationally. And some of the clients are in Singapore and other places in Southeast Asia, where it's typically much more formalized and more due diligence, much longer presentations. It's much more, surprisingly, person to person, humanity. And that can be the start of it. And then, of course, you still have to, as James mentioned with CFIUS, there's still regulations in place. We're not just going to go blindly along, but you explore it together, and people are feeling that way about it.
That's a really good point that both of you have made, and Ben, you touched on this a lot. Like, just reaching out, right? Like, it's a great time to reach out. We're reaching out to all kinds of people because guess what? Like, everybody's got time, and they just want the stimulation of something new.
Time and openness, and I would say helping each other in ways you didn't think of before. It's actually, we were pitched into this crisis. We're pitched into this adventure without our knowing. But now that we're here, we are finding new ways to rely, and even if it doesn't end up in a big partnership, that's okay. Now we know them. Maybe business number 5 will come to the fore in the next thing, or the next season, and all of a sudden you have a wider network and another. So it's a very hopeful, in that sense, it's a very hopeful time.
Mm-hmm. So we are 10 minutes over, and I'm really glad that we got those questions and we answered them, and we did what we did. I think we'll wind it down now. Everybody, thank you for joining us. Ben, thank you for participating. James, the nice thing about both of these guys is that you can hire them. We don't get that with all of our speakers. They're super talented. Both companies are friends of ours, really great folks at both places, and they are just they're some of the best in their field. So if you like what you heard, you can just reach out. We can put you in touch. Just let me know, and they can talk to you and help you through some of these things. So thank you again, everybody. Really great, and we're getting things coming in too. Remy says thank you.
And thank you, Julian, for having us and for hosting so well.
My pleasure. And also one last comment, NMS Consulting was a partner on this. Thank you very much for the support, NMS.
Very welcome.
All right, guys.
Thank you.